welcome back to the Farming Without the Bank podcast. Thank you very much for being here. I appreciate it. This is going to be a fun podcast for you all because you want to always know how the policy is structured. What does that look like? All those good questions. And I had a great meeting today with an existing client. And so I want to share how those policies are structured, which is better than the next. Okay. I'm going to lead with the fact that nothing is free and there are no deals in the insurance industry. That there was a gentleman in this industry years ago and he said there are no deals in the insurance industry. Okay. So when we structure a policy, you either get access to your cash value up front or you get access to cash value later in life. Now, with that being said, there is also the modified endowment contract that we have to look at. If we give you access to cash value up front, meaning you get access to 75% of your premium right away, that policy is going to become a modified endowment contract, a MEC. That's going to MEC sooner. So typically around year 15, maybe 20, maybe 25, depending on what your age is. Typically 15 to 25. If we don't structure it that way and we structure it instead to not put as much money in cash value, then we will have a policy that does not MEC possibly, or maybe it'll MEC at year 40. So today I had a client that said, Mary Jo, I don't want to have 49 life insurance policies. I want a policy that is the premium's not going to drop down because of the MEC. So those of you that have my book, you will see the illustration in the book, the one illustration on Don and Anita. We have $100,000 of premium going in, but then eventually it drops down to $22,000. So when they retire, the premium's only $22,000. And most of you listening are like, oh my gosh, that's the best thing ever because I'm retired and I don't have income. I don't agree with that comment. I agree with my client that I talked to today who is like, you know what? I might have land to sell. And so I'm going to need a place to put money and a $22,000 premium isn't going to be enough. So he came in and said, Mary Jo, I don't care about cash value and I don't really care about death benefit. All I care about is that I have a place to put $100,000 until we die. So, because we don't know what that is, I want to at least get to age 100. So we have a place to put money because what if we have assets to sell? What if we have income coming in? He's in his 30s. So what happens in, 60 years from now? $100,000 is pocket change, right? Because of inflation. And so he's really looking long term at, I need a place to store my money and I don't want to keep starting new policies every year. He's like, well, I thought I was going to have to start every 3 years, but I've been starting every year. So I just don't want to manage all these policies and I want a warehouse for my wealth. Get it? Nelson wrote 2 books. His second book is Warehouse of Wealth. We should be creating a warehouse to put our money. So what did we have to do for him? We took his premium and we split it 50% to death benefit, 50% to cash value. So instead of getting access to 75% of cash value right away, he's only going to get access to 50. Some of you are like, oh my gosh, I can't give you 50%. Okay. Well, if you look in my book, you will also see that the break-even period, the time at which your total premium you put in matches cash value. Okay, I call that the break-even period. That typically is going to happen anywhere between year 8 and 10. If we don't put as much money to cash value, that's actually going to happen later. So instead of his break-even period being year 9, let's say, he doesn't care about that. He wants long-term. So now his break-even period is year 13. So he had to wait 4 more years to get access to a little bit of money. It was not a lot, right? He's not giving up access to a whole lot of money in those 4 years. So then he said, well, is there any other way I can structure this policy? I said, yeah, you could put you could have, because he said, well, we could have this is like old-fashioned whole life. And I said, no, old-fashioned whole life and traditional whole life is all the money goes to death benefit. That is typically how whole life is sold. All the money goes to the death benefit portion. And most people will say, oh, that's a horrible policy. Oh my gosh, it's horrible. It's horrible. Remember, there are no deals in the life insurance world. So we looked and we ran the difference. A traditional whole life, instead of breaking even at year 13, broke even at year 17. Okay? So just another 4 years. But what happens, so if we split it so that the premium is 50% to death benefit, 50% to cash value, what happens if we put it all to cash value? Guess what? At 90 or 95 years old, there was actually more cash value and more death benefit in the old-fashioned whole life policy. So when we're talking about infinite banking and people say it's a better policy, it's only better because you are getting money up front. So it's going to grow faster it's going to grow slower long term. Okay. If you have old-fashioned whole life, you're going to get nothing up front, but eventually it's going to catch up and basically perform the same. You got to wait a very long time. And most people don't want to do that. The other thing is when I structure a policy with 75% of your premium going to cash value, that policy will MEC. It will become a modified endowment contract. It will MEC sooner. So as you can see in the book, I'm putting 75% of the premium to cash value. So typically, let's use $100,000 as an example. You can put $100,000 in for maybe 15 years, maybe 13 years, at which point the premium has to drop down to $25,000, $22,100 is what the book shows. So then the premium is going to have to drop down. And most people say, oh, that's absolutely fantastic because I'm retired and I don't want this high premium. So we're putting all the money in up front. And then the premium drops down. Well, this specific client said, I don't ever want that premium to drop down. I want to be able to put $100,000 in till the day I die. Because I'm always planning to have money and I'm always going to need a warehouse to put that money. Right? There is no MEC in that situation. So we can have the money up front. We can push all the money into the policy up front, have access to it, and then the premium drop. And now we've come into money and we don't have a place to put it. Or we can split the premium so it's 50-50, have access to less money up front, but have just as much money, if not more, long term, and a place to house premium. Now, I hope I explained that, and that because that all came out of my head, right? But for whatever reason, I feel like I've jumbled it a little bit. But there are several ways, and this is why we talk about using a certified agent, using somebody that's looking at your finances, not somebody that you just walk into and they go, oh, yep, this is what we're going to do. Right? Because most of you that come see me do not think like this client that I had today. The majority of you are going to say, you know what, Mary Jo, no, thank you. This isn't for me. I cannot give up access to that much cash. However, if you do think like him, you're going to have all the same amount of money. You're just going to have to wait a little bit for it. if you can give up access to cash, you're going to have a place to house money in the future. And if we have a farm, if we have a business, we're going to need a place to house that money, because we're either going to sell the farm or we're going to sell the business. And I said this to him. I said, well, so this is kind of nice, because if you sell the farm, then you will have a place to put money. And he said, well, this has been in our family for 5 years. I don't want to sell it. And I said, no, I mean, sell it to your son, right? If you're going to sell it to one of the kids, then you have a place to put that money, so that transition happens before you pass away. And he is not scared of capital gains. He absolutely does not care about capital gains. He is one of my absolute favorite clients, because he reads and he educates, and he is so on top of it. And his thought process, he doesn't care if he has to pay taxes. He's not trying to avoid taxes. He's creating cash flow. He's thinking long term. He is doing everything that we should all be doing. He even made me think today, because it's not always that I am being challenged on some of my own stuff, unless I'm talking to colleagues, but I'm usually just teaching, right? And even I can get into a little bit of a rut. And so it was really nice to kind of have a slap in the face about long-term thinking again. And Nelson always said it. This is a long-term thought process, because think about the fact that when he even understood infinite banking, when he created the concept, he did it out of necessity. But prior to that, he was selling traditional whole life. He had a traditional whole life policy. That's where he went to borrow money in the 80s. He learned how to quickly put money into the policy so he could turn around and borrow against it. But Nelson himself would not say, oh, if you don't need the money right away, there's nothing wrong with a policy that you have access to 50% of the money or 40% of the money. If you look at his book, Become Your Own Banker, you'll see that the access to money is different in every single illustration he runs, because every single policy he had was for a different purpose. He was trying to accomplish something different at that point in his life, right? Or within the stories of the book. So we have to look at, what are we using the policy for? What do we want to accomplish long term? If we have somebody that is uninsurable, then I love it when we don't ever mech that policy. Some people will say, oh, Mary Jo, I got a bad health rating because I'm overweight or not healthy or diabetic or whatever. I didn't get a very good health rating. It's going to be too expensive. At that point, I'm not really looking at the expense. I'm looking at it and going, geez, this policy never mechs. So we can put the full premium into this thing our entire life. And when you come into money and with inflation, it doesn't feel like that much money. That is a fantastic warehouse of wealth. Awesome. Absolutely awesome. So think about that when you are, if you are looking at a policy. Everybody is so stuck on getting all of that money in up front, why does it matter? It doesn't matter, right? What is the purpose of why you want it? And I absolutely love his thought process of, I need a place to put money, and I'm frankly tired of starting new policies every year. So let's just get one going that I can put more money in for a longer period of time. And I'm not going to have to restart these things when we're less healthy, right? Because as we get older, we tend to be less healthy and we're older. So I want to start them now. And we're going to be passing on 14, 15. Oh, I'm just trying to think what the death benefit was. Oh, here, I'm going to look quick. We're going to be passing on $20 million of death benefit. That's a lot of money to the heirs. And that's just her policy, right? That's just one of their policies. They have several policies on themselves already. Talk about some massive generational wealth. His kids should be super, super thankful that dad is reading all of these books and he's educating himself and he's listening to things and he's thinking about things and he's punching numbers. So, moral of the story. If you are sitting on money and you can give up access to some of it up front, you're going to get it back in the end at retirement. So you're giving up money. You want access to money today, but that means less at retirement. So do you want access to less money today because you have the ability to make more money? And then at retirement, when you're possibly not going to have the ability to make more money, we have more money in cash value that we can access. And then when we get so far down into it, like, age 80, 90, it basically equals out to be the same thing. Something to think about. Everybody is so worried and they want all this money up front. And I know there are some people out there doing 90/10s, and they think that that's how you should be doing them. I don't see them a lot. People don't talk to me about them a lot. Frankly, they're stupid. Because of the MEC, there's going to be some major issues down the road. So we have to be very careful what we're doing in that, in those scenarios and pay attention. But the structure of the policy meets what? The structure of the policy is going to meet the needs of the client. And this client's need was putting money someplace forever and not having to go back through underwriting all the time and do the health and do the application and start another policy and borrow from 6 or 7 policies when he could just borrow from 1. And just be patient to wait to have access to that cash value 3 years or 4 years later instead of 3 or 4 years earlier, because it's peanuts of what he doesn't have access to at that point. All right, guys, let me know if you have questions. You can email me, maryjo@withoutthebank. If you want to see the numbers yourself on your own, on your own operation, then just schedule an appointment. It's an 1.5-hour consultation. We talk about what you have going on, what the best policy structure is for you. I'm not going to try to sell you something. I frankly am just not here to sell you anything. I'm here to teach you something. And so if you want to learn something, if you want to see how it works, schedule your appointment. You have to read the book first, but once you do that, you'll get emails. After you order the book, you'll get emails with a link to my calendar. So let me know if you have questions, if you have comments, if you want to hear specific topics, whatever. That's what I'm here for. You guys have a fantastic day, and I'll catch you in the next podcast.